What's going on, guys? Mackenzie Long here. So today we're going to break down the differences between term and permanent insurance. And what I'm going to do today is to help you to think critically about it and not give you an opinion. The challenge I see, not just with this topic, but with the entire industry, is that people generally have a product or service that they can sell, and then instead of highlighting what it's good for and applying what it's good for, they talk bad about everything else and then make a case specifically for their one side. And so today I want to talk to you about the pros and cons of each and where they're strong and where they're weak, and allow you to decide which is better for you. Now, the challenge being is most advisors or most people who are going to talk to you about this have one license or the other. They're not able to help you with both of them, or maybe if they do have both licenses, their company doesn't allow them to do both of them. So the reason why I think that there's a challenge with that is they know what they want to sell you, and they've already made up in their mind what they want to sell you before they even know you. And my goal again for today is to help educate you so that you can decide what you believe and which is going to be best for your situation. So let's first start by talking about term insurance. Now, term insurance is exactly what it sounds like. It's for a specific amount of time. Generally, it's going to be 10, 20, or 30 years, depending on its application. It can be used in a buy-sell agreement, it can be used as a key man insurance policy, but in most cases, it's going to be to cover the life of an individual for a particular amount of time. Kind of think about renting. When you rent something, it's kind of yours while you have it, but once you're done renting it, you give it back. You're no longer obligated to it, but they're also no longer obligated to you. So once you're done with your 20 or 30-year term policy, you can potentially reapply and try to get another insurance policy. The challenge is you are now 20 or 30 years older. So that means you may or may not be able to get coverage. So the pros about term life insurance is that you can get more coverage for less amount of money. The cons behind term insurance is that it's specifically designed to not be there when you need it. Outside of something freak happening, some kind of accident, or you passing away too soon, the vast majority of people, if you have a term policy, will not actually use it. Now, I will do another video specifically about term policies with living benefits. To me, that's the only way to go if you're going to do a term policy, but we'll talk about that in another section. So let's move on to a permanent policy. Now, permanent obviously means that it's going to be there for your whole life, which is how it originally started with, was whole life policy. Whole lives are very similar to ULs. They have many differences amongst them. I'm not trying to lump them all into one group, but their main focus is going to be insurance with some savings. They also came out with some ones after that, the variable universal life insurance and the indexed universal life insurance, which are more focused on getting growth inside of that insurance policy. So what do you mean growth inside of an insurance policy? In a permanent policy, it's broken into two parts. You have the life insurance, just like you would in a term insurance policy, and you also have a cash value. And inside that cash value depends on how the policy works, whether it's a whole life or UL or maybe an IUL or a VUL. The working mechanics on that actual cash value we're not going to really talk about today. I just want to talk about the blanket statement of permanent life insurance. So the pros to a permanent life insurance policy is that it's going to last your whole life. So no matter how old you are, when you pass away, you will actually leave that insurance policy behind. The reason why people use it for cash value is there's a special code in the IRS rule book 7702, which states that the money that grows inside of it, if it's done properly, comes out and grows tax-free, meaning the money that you're putting into it is already after-tax dollars, so much like a Roth, is then going to grow tax-free and come out tax-free. The difference from a Roth is that it doesn't have any 59.5 stipulations to it, meaning you could access the money early if you wanted to. It also has no contribution limits, meaning you could put as much money in there as you wanted to. And if you're making over $250,000 or whatever it is that puts you outside of the tax bracket of using a Roth in today's environment, whenever you're watching this, you can still use one of these as your tax advantage plan. Another cool thing about it is it doesn't count towards getting scholarships or financial aid for college because it doesn't show up on that actual form. You exclude life insurance from that form. And you can also attach living benefits and long-term care to it as well. And what's the downside? The downside is obviously it's going to cost more. There's a difference in a term policy, the cost between a 10-year term and a 30-year term, because you're more likely to use it and you're also getting older. So it's kind of like expanding that term idea into a longer period of time, which obviously makes it more expensive because it's going to pay out. But that potentially could be a downside. It also feels more expensive because of that savings component to it, the cash value, that you've got to add money to not only cover the life insurance, which it in of itself is a little bit more expensive, but you also need to add money for the cash value side. So if you're limited on funds, it might not be a good program for you. So let's talk a little bit about the theory behind the two. You're going to have one camp that says buy term and invest the difference is the only way to do it. Now, buying term and investing the difference means get a term policy. If you have $500 a month to spend, it costs you $50 for your term policy. You can then spend $50 a month on your term policy and $450 a month into an investment strategy. And in theory, it sounds great. Now, what I want to bring to you is what actually happens, what happens in reality. Because it's almost like saying, well, if you eat well, you'll be healthy your whole life and then you don't have to worry about doctor bills. And we would love to say that, but unfortunately we're people and things don't always go the way that we want them to. And so a simple question I would like to ask you is, how many people do you know end up in their elderly years and are still working, don't have enough money to retire, and still have lots of liabilities? Now, they probably don't have young kids at this point, but they are probably still married, they're still working, they still have a mortgage, and maybe they're taking care of their grandkids or babysitting for their kids so that way their kids can work. So the question here becomes, do they still have an insurable need, and what percentage of the population does this actually happen to? So I found this article that talks specifically about that, and basically what he did was he took the LIMRA numbers and then analyze them and put them in a concise way to be able to understand it, and I want to share those with you here. He says that 48% of all people who die leave behind no life insurance. Another 21% simply don't have enough coverage. So they might have some life insurance, but they don't have what they actually need. And he says, does that mean that 31% of Americans actually have the amount of coverage they need? And I would agree with him here in saying that they don't. There's probably another 20% that either don't know exactly what they were answering or thought they had enough coverage and they don't. So it's probably closer to maybe 11% that actually have the appropriate amount of coverage. And I would have to agree with him on that. But even let's say 31% do, that means the vast majority, 69%, do not have either enough coverage or any coverage at all. So almost 70% of the population doesn't have enough coverage. And in case you were wondering, I looked up on statistica.com, but in case you weren't sure, you actually die or are more likely to die. So if most people are going to pass away when they're older, and that's when they actually need life insurance, why do we tell them that they may or may not need life insurance when they're older? So the idea is based on the X curve. And if you haven't heard of this before, it's a great understanding of how life is supposed to go. And so you start up on the upper left-hand side, where when you're younger, you have more responsibilities, you have more liabilities. You maybe recently purchased a home, you've got some kids, you've got debt, you've got car payments, so your liabilities are really high. And what's supposed to happen over time is it's supposed to cross like an X, so that by the time we're in retirement, our home is paid off, our cars are paid off, we don't have any more debt, our kids have moved out, and we don't really have any other responsibilities. And at the same time, our wealth, normally when we're young, starts pretty low, and then it's supposed to go up and to the right, and by the time we're in retirement, we're supposed to have lots of wealth, and low amount of liabilities. And in here creates our ability to self-insure, meaning that if we have millions of dollars in the bank and something happens to me, I no longer need the life insurance because the millions of dollars will replace that life insurance policy. I'm now what's called self-insured. So now the question becomes, is this reality for most people? And I would ask for people in your circle, is that generally what happens? But let me ask you, how often do you think that that actually happens? When I look around the people that I know, and I've been doing this for 9 years now, that's not the case for most people. So I wanted to know the actual numbers, and I found a website called Spend Me Not. And basically they figured out how many people in their retirement years end up millionaires. Now, millionaire, just to break it down very quickly, you can pull out about 4% from a retirement account, meaning that you live on about $40,000 a year. So if you have less than $1 million, then you are obviously not able to necessarily self-insure. So 1 out of 6 Americans is actually in that bracket, meaning about 16%. So what does that mean for the other 84% of the population? It means that they have not been able to get to a point where they can self-insure. Just statistically speaking, we are failing 84% of the population if we tell them to buy term and invest the difference. Now, I wish that wasn't the case. I wish they were buying term and actually investing the difference. However, I just don't see that happen very often. And unfortunately, it's usually about their time that their policy is ending that they're reevaluating these things. The problem with it is that generally they've had some kind of health issue. Maybe now they smoke and they didn't, or they've had some kind of heart attack or stroke or something along the way. They're on blood pressure, they're on more medication, usually in their late 50s and early 60s or mid 60s than they were when they were younger. So the cost of that term policy goes through the roof. We're talking hundreds of dollars a month, sometimes 5, 6, 7. I've seen it into $800 a month. And so the challenge is they simply cannot afford 2 policies now specifically for a term. So now they don't have much money. They also have no life insurance, and we kind of just tell them good luck. On the other hand, if they had a permanent policy, yes, they might have been paying more, but they would be forced to do the buy term and invest the difference. It's just inside the same policy. So now, even if they couldn't continue to pay on that insurance policy, it would pay for itself, so they at least have some life insurance to leave behind. So here kind of becomes the conundrum in who is right. Because the biggest challenge to a permanent policy is that you actually keep paying into it. Because even though it says permanent, it still has a cost to it. If somebody was to stop putting any money into it, it would first use the cash value to save the life insurance. But once the cash value is gone, if we're no longer putting money into it, we obviously won't have any life insurance either. So it boils down to the age-old question of which one is actually right. And why I think this is an important question is because the answer is not right for everyone. And I think it should be treated on a case-to-case basis. So what you need to know up front when you're going to talk to somebody is, do they personally have a preference? Do they have a dog in the dog fight? Can they only offer one or the other? Because I think that is dangerous in and of itself. Because obviously if they don't offer it, they're not going to tell you to go to somebody who does. And I see this quite often on both sides of the aisle. A lot of people only offer permanent, and a lot of people only offer buy term and invest the difference. So I think the best thing that we can do for people is educate them, educate you, and allow you to figure out what is best for your particular situation. So I hope this was helpful for you. Make sure you smash that like button and also hit the subscribe as well. It sounds like I need to do some follow-up videos, so I'm gonna have to do a video on the term with living benefits, because I think that's really the way to go if you're going to do a term policy. It makes way more sense. And it also sounds like we need to do some education around permanent policies and how they actually work, because you hear a lot of fallacies about those as well. So make sure you hit the little bell next to the subscribe button. That way you can stay in contact when the new videos come out. And as always, I hope you guys have a great day, and I will catch you later. Bye.